Welcome to This Explainer. Okay, if you've been glued to the charts this week, you already know the market just served us a massive slice of humble pie mixed with a whole lot of pure volatility. So let's just dive right into it. Today, we're unpacking this recent market shockwave and giving you a bit of a masterclass on navigating macro volatility. This is especially for you retail investors out there trying to make sense of the absolute chaos we just witnessed. Look, we're going to strip away all the noise, look strictly at the data, and turn what was a very complex, painful week into a clear, actionable strategy. And absolutely crucial for you beginners, we'll also be covering the massive digital security mistakes that wipe out portfolios way faster than any market crash, just so you can lock down your assets before the next wave of volatility hits.
To help you step away from reactive fear and actually build a proactive strategy, here is our roadmap for today. We're breaking this down into 6 logical steps. Number 1, the $51 million liquidation. 2, macro forces driving volatility. 3, key levels for BTC and ETH. 4, altcoin divergence and layer 2s. 5, surviving the liquidity hunt. And finally, number 6, your 7-day trading roadmap.
All right, starting things off with Section 1, the $510 million liquidation. Over $500 million. Just let that sink in for a second. That is the staggering amount of capital completely wiped out in the time it takes you to sit down and watch a movie. The vast majority of these were over-leveraged long positions getting absolutely decimated as Bitcoin slipped to a 10-day low, right down near that $63,000 mark. And listen, you have to understand, this wasn't just some simple dip in price. Oh no. It was a mechanical, brutal transfer of wealth from impatient retail traders directly to institutional algorithms. When you see numbers this incredibly massive, you realize this is the market functioning exactly as it was designed to. It literally flushes out the excess greed to reset the board.
So what we're looking at here are the mechanics of a leverage flush. This is the exact scenario that plays out when we enter these macro-heavy weeks. The thing is, the market just doesn't care about your feelings, your hopes, or your underwater positions. It only cares about liquidity. And right now, overeager retail traders who aggressively pushed into breakout trades right before major Federal Reserve policy decisions, well, they just provided a massive, irresistible pool of liquidity for the market makers. If you want to survive as a retail investor and actually build generational wealth, you've got to position yourself so you aren't the one providing liquidity to the whales. You really have to learn to spot the setup before the trap snaps shut.
Moving right along to Section 2, macro forces driving volatility.
To understand why this massive flush happened, we really need to pull back the curtain on the macro forces pulling the strings. We witnessed a massive macro tug-of-war this week. You see, you just cannot trade digital assets in a vacuum anymore. They are entirely, fundamentally woven into global finance. For a minute there, the bulls were in absolute control. Earlier in the week, Bitcoin surged past $65,000. The catalyst for that? Well, the Federal Reserve decided to hold interest rates steady, which signaled a potential softening of monetary policy. This actually pushed the total crypto market cap up toward that $2.1 trillion mark. But, as we all know, gravity in these markets is unforgiving. Out of nowhere, a sharp sell-off in traditional markets, specifically a massive drop in Asian semiconductor stocks, triggered this global cascade effect. Wall Street got spooked, risk-off algorithms kicked into high gear, and that traditional market fear rapidly bled directly into our digital asset ecosystem. It instantly neutralized all that bullish momentum and pulled Bitcoin right back down to earth.
Okay, Section 3, key levels for BTC and ETH.
Now that we see the big macro picture, let's zoom in on the exact microscopic levels you need to know to survive this chop. If you're going to trade the reality of the chart rather than raw emotion or hopium, these are your absolute boundaries. Look, Bitcoin is attempting to recover, but that $63,000 mark is our immediate line in the sand. If this fails on a daily close, we're likely looking at a retest of lower liquidity pools near the $60,000 psychological level. On the upside, that $64,500 to $65,500 range, that is a massive resistance block, filled with trapped buyers who are just desperate to break even. As for Ethereum, we're seeing a classic battle. Its short-term spot ETF outflows clashing against long-term structural supply crunches. Your safety net there is anchored right between $1,865 and $1,880. Please do not try to front-run institutional capital at these levels. Institutions have algorithmic bots operating in milliseconds, backed by billions of dollars. Trying to jump in front of them right before support hits is literally like stepping in front of a speeding freight train just to pick up a shiny quarter. It's just not worth it. Buy the confirmed support, sell the resistance, and use strict stop losses just outside these bounds.
Next up, Section 4,
Altcoin Divergence, and Layer 2s. So while the major assets were correcting, we actually saw some fascinating, resilient divergence happening underneath the surface. Usually when Bitcoin sneezes, the altcoin market catches a severe cold and completely cascades. But Solana showed incredible, surprising resilience this week, gaining up to 5% early on before the broader market drag took effect. You need to keep an incredibly close eye on the SOL to BTC trading pair. If it breaks resistance, we could honestly see a massive rotation of capital into that ecosystem. Also, pay close attention to Ethereum Layer 2 networks, specifically Arbitrum and Optimism. Despite Ethereum's sluggish price action on the mainnet, transaction volumes on these Layer 2s are hitting all-time highs right now as users flock to lower fees. The actual utility and value transfer are quietly exploding here, making it arguably the most asymmetric bet in the space right now for long-term accumulation. And hey, for those of you watching XRP, yeah, it did pop briefly. But let's be totally honest with ourselves. We are still trapped in a multi-year wedge so long it practically qualifies for a mortgage by now. Set your alerts, for sure, but don't force a trade until there's genuine structural breakout confirmation.
This brings us to Section 5, Surviving the Liquidity Hunt.
Let's transition into our systems masterclass and talk about the anatomy of a trap. If you are a newer retail investor, I really want you to pay attention because this is the single most important lesson you can learn about surviving volatility. We call this the liquidity hunt. When major macro events, like that Fed rate decision, are on the calendar, market makers intentionally widen the trading ranges. Why? To stop out retail traders on both sides of the tape. Here's the exact playbook. First, the price artificially spikes opposite to the true underlying trend, triggering breakout algorithms. Second, and this is the dangerous part, retail traders feel the FOMO. The dopamine hits, they see the big green candles, they completely abandon their trading plans, and they emotionally pile into long positions at the absolute local top. Third, once enough retail liquidity is trapped up there, the big players aggressively dump the price, triggering stop losses all the way down the order book. Finally, that cascading sell pressure allows whales to accumulate massive positions at deeply discounted prices. Never, ever trade the initial spike during a macro news event. You have to wait for the dust to settle and identify the true continuation so you don't become the prey.
Protecting yourself against these traps requires systemizing your macro alignment. Think of this relationship like a massive financial seesaw. On one side of the seesaw, you have the US dollar index, the DXY, and the 10-year treasury yields. On the other side, you have risk assets, like crypto and tech stocks. When the dollar gets heavier and yields push down on their side of the seesaw, risk assets don't get flung into the sky, they get dragged down in value as capital flees to the safety of government yields. It is a fundamental law of modern financial physics. When the US dollar and treasury yields go up, risk assets like crypto go down. This week, those rising yields put a hard, impenetrable ceiling on Ethereum's growth. By tracking these traditional macro indicators, you can adjust your risk exposure well before the crypto charts even show a single sign of weakness. That's the edge you need.
Now let's talk about survival. Capital preservation is always, absolutely, the ultimate priority. In a market where $10,000 Bitcoin swings are becoming entirely normalized, your position sizing must be microscopic compared to your total portfolio. If you are a retail investor using 10x leverage in this environment, you're not trading, you're gambling. A standard daily fluctuation will completely wipe you out. Strict risk management demands that you risk no more than 1% of your portfolio on a single setup. But listen, for beginners, risk management doesn't just mean stop losses and position sizing. It critically means operational security. We are seeing core security risks absolutely skyrocket during these volatile macro weeks. Scammers know you're stressed. They know you're constantly refreshing Twitter for information. That's why phishing scams disguised as urgent macro news alerts or fake protocol airdrops are at an all-time high right now. Furthermore, one of the biggest digital wallet mistakes beginners make is leaving significant capital on hot wallets or centralized exchanges during high volatility events. In extreme market flushes, centralized platforms can, and often do, temporarily halt withdrawals to protect their own liquidity, leaving you entirely helpless. Or worse, out of pure panic, you might interact with a malicious smart contract, draining your Web3 wallet instantly. So right here, right now, here is your immediate security checklist. Number 1, move your long-term holdings off exchanges and onto a cold storage hardware wallet. Seriously, if you don't hold the private keys, you do not own the coins. Number 2, go into your Web3 wallet settings and regularly revoke unnecessary smart contract permissions. Do not leave open approvals for protocols you aren't actively using. And number 3, immediately enable hardware-based two-factor authentication like a YubiKey or an authenticator app on all your exchange accounts. Do not rely on SMS verification. It is incredibly vulnerable to SIM swap attacks.
Look, if your underlying account isn't completely secure, your fancy chart analysis and trading strategy literally do not matter. Lock the vault first.
All right, bringing it home with Section 6, your 7-day trading roadmap.
Let's pull all of this data together into a really clear, actionable roadmap for the days ahead. For the next 7 days, we expect continued consolidation for Bitcoin between that 63,000 support and 65,000 resistance range we outlined earlier. But you must keep an eagle eye on the incoming macroeconomic data drops. Specifically, we're looking at core PCE inflation data and second quarter GDP revisions. These macro cues will dictate the Fed's next move, which in turn dictates the flow of global liquidity. Also, keep watching those traditional tech earnings and spot Bitcoin ETF flows. A return to net positive inflows there could quickly invalidate the current bearish sentiment. Above all else, do not overtrade this range. Keep your leverage practically non-existent, keep your patience incredibly high, and strictly favor spot accumulation over derivatives. I really want to emphasize this for new retail investors. Sometimes sitting on your hands and doing absolutely nothing is a highly profitable, perfectly valid trading strategy during these chaotic, data-heavy weeks.
You know, it's very easy to look at the red candles across the board and instantly assume the worst. So I want to address a question we're seeing pop up everywhere right now. Is the bull market structurally over? The data overwhelmingly says no. Short-term weakness does not equal structural deterioration. The core crypto ecosystem is fundamentally stronger today, with way more adoption and clearer regulatory pathways than it was even 6 months ago. Institutional interest remains entirely intact. The big players, they aren't panic selling. They are simply redistributing and accumulating. Remember, fortunes are built in these exact, boring, choppy, frustrating red weeks. This is where wealth actually transfers. The bull market is not over, guys. It is simply resting. The market makers are merely flushing out the weak hands before they build the foundation for the next major leg up.
So, what does this all mean for you? The market is actively testing the conviction of every single participant right now. As you face the volatility of the week ahead, the biggest variable to your success isn't what the Federal Reserve does, and it certainly isn't what Wall Street does. It is strictly what you do. So, I have to ask, is your trading system disciplined enough to survive the chop? Stay rational. Trust the data in your systems. Manage your risk and digital security meticulously, and never ever let emotion dictate your entries. Trade smart, stay well ahead of the curve, protect your capital, and we will see you in the next explainer.